I would now like to go over exercise 6-5 in your textbook, and it's on March 1st, 2021. Gold Examiner received $147,000 from a local bank and promises to deliver 100 units of certified 1-ounce gold bars on a future date. The contract states that the ownership passes to the bank when Gold Examiner delivers the products to Brinks, a third-party carrier. In addition, Gold Examiner has agreed to provide a replacement shipment at no additional cost if the product is lost in transit. The standalone price of the gold bars is $1,540 per unit, and Gold Examiner estimates the standalone price for the replacement insurance if the gold bars are lost in transit to be $60 per unit. Brinks picks up the gold bars from Gold Examiner on March 30th and delivery to the bank occurred on April 1st. How many performance obligations are in this contract? Now remember, the two criteria has to be that the goods and services are distinct for the both instances. Capable of being distinct means the customer can use the goods and services on their own, or they can purchase it somewhere else, and they are separately identifiable. The seller promises to provide the goods and services individually. Based on those requirements, there are two obligations. The delivery of the gold is one obligation, and the insurance is capable of being distinct, so that's the second obligation. Prepare the journal entry Gold Examiner would record on March 1st. Now, first, we have to, because there's two obligations, we have to allocate the selling price gold receives of $147,000 between two obligations. The standalone price of the gold bars were $1,440, and the standalone price for the insurance on the gold bars were $60 times 100 units. So the total price for the value of the bars is $144,000, and the total price for the insurance is $6,000. So the standalone price is $150,000. Well, what we need to do now is take that $150,000 and find the allocation of the gold bars calculation above, divide it by the full $150,000, and do the same thing for the insurance. So the value of the gold bars are $144,000. If you take $144,000 and divide it by the total standalone price of $150,000, that's 96% of the amount Gold Examiner would receive. So how much are they receiving? They're receiving $96,000 times $147,000, the amount they would receive. So the allocation of the cost of, or the selling price of the gold bars is $141,120 for the Gold Examiner. Now we know this has to be 100%. If 96% is allocated to the gold bars, the remaining 4% is the insurance. So 4% times the $147,000 is $5,880. Now, what's the journal entry for March 1st? We have this information. And the Gold Examiner will receive on March 1st $147,000, and the deferred revenue pertaining to the selling price of the gold bars is $141,120, and the deferred revenue for the insurance is $5,880. The reason that it is deferred is Gold Examiner has received the cash prior to the delivery of the two obligations. And requirement 3, prepare the journal entry Gold Examiner would record on March 30th. So what happened on March 30th? Brinks picks up the gold bars from Gold Examiner on March 30th and delivers them to the bank on April 1st. We know that ownership passes to the bank when Gold Examiner delivers the product to Brink, a third-party carrier. So the actual delivery of the bars would be transferred from deferred revenue to revenue because the ownership transfers to the third-party carrier as soon as Gold Examiner gives the third-party carrier the gold bars. So you would debit deferred revenue for $141,120, and you would credit sales revenue for $141,120. However, delivery did not happen till April 1st from the carrier. So at that point, Gold Examiner was responsible for the insurance of the gold bars until they were delivered. And at delivery date of April 1st, it is a debit to deferred revenue for the insurance of $5,880 and a credit to service revenue for $5,880.